This is how you grow a small options account as fast as possible whilst being as consistent as possible. So we want to open up a watch list first of all, so we can get a list of underlyings that we can potentially trade. Every single underlying, of course, needs to have options available to trade on them, otherwise it's no good to us. We're just using a default broker provided watch list. It doesn't matter what's on your watch list, just as long as everything is liquid. You'll be absolutely fine. We are product indifferent, meaning that we don't actually care what the underlying is as long as it fits our criteria. And you want to have IV rank on your watch list. You want to order everything from high to low IV rank, because IV rank, it tells you where implied volatility is for that specific underlying relative to itself over the past year. So it gives us an indication of where IV is for that particular underlying. So if it's 100, then that means it's the highest it's been. If it's 0, that means it's the lowest it's been over the past year. So it's a very important metric. And we are only interested in looking at things to trade that have an IV rank of 30 or above. Okay, that's very important, because over 30, we have a pretty good edge. And you also want to have these filters on. So you want to exclude any underlying that has earnings over the next 45 days or so. Because we don't want earnings to come along whilst we're in a position or whilst we're in a trade, just in case if earnings completely messes up our deltas, etc. It's just going to be extra work for us to have to manage that position. And you also only are interested in underlyings that are pretty liquid, so the 1 and 2 star liquidity rating stuff, we're just going to remove those. So if your broker platform allows you to filter out things like this, then this is what you want your filters to be. And what you'll be left with is something that looks like this. And you just want to go down the list and see what would, number one, fit well in your portfolio, and number two, what has a nice IV rank, a nice healthy IV level. And what's sticking out to me is Palantir, which last traded at 84.9. It is a Saturday, so the market's closed right now. And it has a nice IV rank of 85 and an absolute IV level of 79.4%. So we should be able to collect some nice premium on Palantir. So next, what you want to do is open up the list of expiration dates for Palantir, and you want to pick an expiration date that's between 30 and 60 days out in time, and you want it to also be a monthly expiration date, not a weekly or quarterly. And so there's only one here that fits our criteria, which is 40 days out, April 17th. So we're going to open that up. And now we are presented with the options chain. So I'm assuming everybody already knows what an options chain is, but very quickly, calls on the left, puts on the right. This orange horizontal line shows us where the price of Palantir is with respect to the strikes that are going down the middle here. We have our standard deviation levels shown by these dotted blue lines. And at the top right, we have our IV, which is at 78.6%. And in parentheses, which is very important, it shows us our expected move, which is currently plus or minus 15.25. And that's also visually displayed with this vertical orange bar here. So if your broker platform doesn't display it visually like this, then you can just manually calculate it using the expected move in parentheses. And what we're going to be doing is we're going to be writing the contracts. Okay, we're going to be selling or we're going to be short the contracts. We're not going to be buying a contract. For example, if you think Palantir is going to go up, you might typically buy, the 85 strike contract and hope price moves up. We're not going to be doing that. Okay. Mainly for the simple fact that if you look in the bottom left here, we see our POP, which is probability of profit, is very low. It's around 30, 35. Well, right now it's 36%. So it's very, very low. We want high probability trades. So when you are writing a contract, you want price to stay away from that contract. In the example we just showed you, where we are long the 85 strike, we want price to move in the direction of the contract and keep going. But if we were short this contract, we want the opposite to happen. We want price to stay away from that contract. So where do we sell these contracts? Well, if we want price to stay away from our contracts and we know what the expected move is, we simply just need to sell outside of the expected move, and that's going to give us a high probability of success. So I typically like to be around 15 to 20 deltas. And so you want to make sure you have the delta column on your your calls and puts as well. So we're just going to find something between 15 and 20 deltas. So we've got a 17 delta here at the 110 strike. We're going to sell that. and we have a 16 delta here at the 67.5 strike. Or we also could go to the 70 strike if you wanted to. That's got a 19 delta. Either one will be fine. We'll just go with the 19 delta here at the 70 strike. So what we've basically done now is we've created a range for ourselves. Okay, we've created a range for ourselves that we want price to stay within, and as long as price is within this range at the point of expiration, we're going to keep all of the premium that we collect up front. So what's the chance of making money on this position? Well, if we look in the bottom corner, we have a pop of 69%. So that means we've got a probability of profit of 69%. So already the odds are in our favor. And if you want to get out of this position at 50% of max profit, which is personally what I do, then we have our P50 number here, which is 83%. So our actual probabilities of success on this position is going to be around 83%. So we're going to be winning almost every single trade that we place. And it's a very simple trade setup. This is what the trade looks like. So let's dive into the numbers a little bit more. So if we were to get filled at this mid price of 4.36, that means we would collect $436 up front in premium. That's going to get added to our cash balance by our broker automatically. And our broker is going to require 4.6k in buying power to open this position. Now you might be wondering, you said in the title that this was for a small account, and you are correct. So I'm going to show you what you can do to basically still keep this position, still enjoy our high probabilities of success, and enjoy the mechanics of selling out of the money contracts. But what I'm going to show you is how to massively reduce your buying power requirement to make it so that your position will fit inside a small account. So what you want to do is use some of this premium that we're going to collect, $4.36. We're going to use some of this to buy some long contracts to cover our short contracts. So let's just say we come one strike down, $5 wide, and we buy the 115. So we spend $1.33 and buy that. And then we do the same thing on the put side. So we come down to the 65 strike. Remember, we want to keep it the same width, so $5. And we spend $1.77 and we buy that contract. So now we've used some of our premium to buy these two long contracts. So now our premium has reduced to $1.41. However, our buying power has now also reduced to $359 because our buying power requirement is now calculated off of the max loss. And our max loss is calculated from the spread of our strikes, which is $5, minus the premium that we collect, which is $1.41. You multiply that out by the contract multiplier, which is 100 for equities, and you get your max loss. Your broker knows what your max loss is, and so it only needs to hold that much in buying power to cover you in the worst case scenario. And so that's how you can manipulate a naked position and make it into a covered position and reduce your buying power requirement. So what you will have noticed is that your pop will drop slightly. So your pop is now 62% and your P50 is 76% as opposed to 83, I believe it was. So your probabilities of success have dropped by a couple of points. However, if you now look at your return, instead, before we were making around about a 10% return in 40 days, and now we are making much more than that because we collect $141 up front, and our broker is going to require $359 in buying power. So our buying power, our return on capital is much closer to 50% now. So our P50 has dropped by 7%. However, our return on capital has tripled, perhaps even quadrupled compared to what it was before. So this is all you need to do. And if $359 is still too much for you, just pick a smaller underlying, something, maybe say Intel, for example, where you'll be able to go $1 wide, $2 wide, $3 wide, etc., where you don't have to necessarily go in increments of $5. Alternatively, you can be more aggressive. You can go to say the 30 delta, still keep the width of your strikes the same, $5, but let's say we go to a 30 delta on either side. And now, because we're collecting more premium, our width is still $5 on either side. So it's $5. Our max loss is now $5 minus the premium, which has increased, multiplied out by the contract multiplier, and now we get our max loss of $242. So it's basically still the same position. We're a bit more aggressive now, Our return on capital has increased to over 100% because now we collect 258 and we're going to put up 242. So now our return on capital is over 100%. And our buying power requirement has reduced even further now to $242. In turn for this higher return on capital, we have a lower probability of success. Our P50 is now 62%, as opposed to 76, I believe it was. So this is what you need to do over and over again. Just play with the position. Start with something between 15 and 20 deltas. That's always a good starting point. Then you can be more aggressive from there if you choose to. And you want to do this over and over again as many times as possible within your risk parameters. And you want to have lots of occurrences, roll the dice lots of times to eliminate short-term variance and just let the odds work out over time. And that's it basically. And you do need to keep in your buying power in check. You do need to be managing your risk appropriately. And what we've done is created a free position sizing template that's available for everyone to get a copy of. The link is in the description. It's completely free, and it'll take you over to the spreadsheet. And the way it works is you just enter in the size of your portfolio. So say if it's $25,000, you enter that, and then below it you enter in what the current VIX level is. So say if it was 32.8, and then everything, as you can see, is going to be calculated for you. It's based on your portfolio size and also on the VIX levels, which is basically a proxy for the volatility in the market. When there's more volatility in the market, you can be more aggressive because your edge is higher, and also the chance of a black swan event is lower when the VIX is higher. So you can be more aggressive when the VIX is high, basically, and it dynamically calculates it for you. If you do have a super small account, a couple $1,000, you may have to be slightly more aggressive just due to the nature of it being such a small account. However, if you do have a bit of a larger account, you definitely should not be violating these guidelines. And with the techniques that I showed you in this video, no matter the size of your portfolio, you should absolutely always be able to find positions to trade. Now, if you do want to learn in more detail about what we do and how we do it, the link will be in the description. But this time, click on EDS Premium and get yourself signed up. Once you're inside, you will have access to this exact portfolio that I showed you in this video, where you'll be able to see all of the positions that we place, how we manage risk, how we make adjustments, everything in real time. You can use that information to study and reverse engineer, or you can simply copy us. It's completely up to you. And there's also a full course as well. So no prior knowledge is required. We're going to teach you everything that you need to know from start to finish. And if you ever get stuck, you can speak directly with myself or with other like-minded individuals that are already inside, as it's a private community. And there's a 100% money-back guarantee. So after 6 months of being inside, once you've been through the course and followed some of our trades, if at that point you are not profitable, then we will just work with you for free until you are, or you can request a full refund. And it's $9.99 a month to join right now. The price will be increasing. However, once you're in, the price is locked in for you for life, so you are rewarded for getting in early. And the aim of EDS Premium is to teach you the skill. We don't want to keep you dependent on us. We want to give you the skill. Once you've learned it, no one can take it from you. It's very powerful. It's a very powerful thing to know. And we want to get you to a point of where you are completely self-sufficient within 6 to 12 months. So with that being said, I will see you guys on the inside.